Guys, markets are changing. Property market, money market, mortgage market, all markets. We've got one of the best mortgage brokers out there, Zach, here for you live today. If you've got any questions, stay tuned.
Good morning, gents. Zach, thank you for joining us. The best mortgage broker in the country who's looked into
world.
it in his little pool, and he's told us times have changed, and you better be ready because we've got some good news and some bad news for you.
Morning, gentlemen. How are you this morning?
Hello, Professor Zach. Good, thanks. Happy Mother's Day.
Same to you.
Did you not spend time with your mum yesterday, Zach?
Mate, I'm in debt to her always, as I'm sure you both are. But I did reach out over the phone, so yeah, she'll be getting my presents this weekend.
Nice. And Billy, you were down at Stella Blue?
I made a big effort, Mark, and it paid off, as mum deserved.
And I went to Petersham. I went to a chicken restaurant in Petersham, Portuguese chicken, and consumed a lot of food. Good morning, Ben. There you go.
Good. On with the show. We've got a few things to talk about this morning. Some exciting stuff as well. Do we want to crack on with the most recent news coming out from the RBA?
Yeah, absolutely. Well, as we saw on the 3rd of May, they finally hiked the rates, first time in 11 years, to 0.35%, 25 basis points. So
yeah,
there's a lot of headlines out there stoking the fire. But I guess this was off the back of the quarterly inflation exceeding the expectation. It's 5.1%, 3.7 trimmed. So, I mean, if no one knows what trimmed inflation is, that's the alternative measure, which is more targeted towards a personal consumption expenditure. So, excluding any external factors. Mark, you're looking a bit surprised there, but it's more relevant to the consumer rather than including things such as COVID, the election, Ukraine war. So,
right,
they've finally done it to curb inflation, and the banks have passed it on.
After 11 years. But I think in all fairness, and I said it the other day on the show, like it's a bit of forced savings, I reckon.
Well, that's it. I mean, we couldn't continue on such low interest rates for so long. The banks have done a good job getting us through, or the government has done a good job getting us through COVID. And now it's time for the economy as a whole to bounce back or forward, if you like. And again, our economy is one of the strongest in the world at the moment.
Incredible. Hey, Zach, I've got a question for you. 5 days of broking, Monday to Friday last week. What was the most common conversation you were having with your customers?
Look, a lot of people were asking, how does this affect my mortgage? The beginning of COVID, 2019, 2020, a lot of people decided to refinance and fix rates for 2 to 3 years. So I'm seeing a lot of people refinance at the end of those fixed periods now in 2022, and we will see that again as a common theme for our business. 5 days a week, Mark, refinancing, getting people a better deal on their rollover rates. So that is a common conversation. I guess for people who are in the middle of fixed periods, the rate rise isn't going to affect you because you're fixed. But any variable customers, the banks will be passing on those rate rises, and it will change borrowing capacities as those rates do rise.
So already changed borrowing capacity with that rate rise, did it? Or was that already factored in?
Well, when a lot of these mortgage borrowers at the moment, may not have experienced a rate rise cycle, but a lot of the mortgages since 2016, when APRA changed regulation, have been taken out under stronger lending conditions. So they're positioned to actually handle some of these rate rises. So there was a buffer that was brought in to assess people's serviceability, which now, whilst repayments might be changing, increasing, whatnot, these people are positioned well to handle the rate rises.
But you were saying, Zach, the economy can afford this at the moment. The government's, picked a time that's sort of maybe the best time in 11 years, could you say?
Yeah. I mean, look, there's probably never a good time to hike rates, but there are some strong indicators that the economy can offset the rate rises. What I mean by that is that we've got a full employment economy. There's record low unemployment of 4%. There's some wage growth being felt in some sectors, although the official stats don't come out until the 18th of May. And a lot of households are actually ahead of their mortgages. So compared to 2020, there is currently around 0.25% of loans in negative equity compared to 2.25% 2 years ago. So, and as you said before, the savings factor, especially through COVID, especially also held by residential property owners, there's about $232 billion in offset accounts at the moment. So there's a huge portion of savings that could potentially drive some more investment in the real estate market.
Guys, if you've got any questions out there in the ether, if you want to ask Zach, mortgage professor, Zach, I'm calling you this morning, mortgage broker, fire away. Something I just picked up on what you just said then. There was 2.2% default, and now it's down to 0.2% default rate.
Sorry, Mark, getting a little bit of echo there. There was 2.25% negative equity in the home loans in 2020, and now it's about 0.25%.
Negative equity.
Yeah.
Negative equity.
That's insane.
So, I mean, there's some indicators that the economy can handle it. I mean, we know that overseas migration will ramp back up and that there's still an undersupplied property market. Mark, what are you seeing? Are you expecting that there's going to be some more realistic competition in terms of pricing, and with the migratory factor, do you think that'll improve competition in the market?
We've gone from a seller's market to a buyer's market, and we've swung, and that swing has taken 6 months.
Okay.
Yeah, value is becoming, good point with Ben. Hearing lots of sales are falling over. Value is becoming tough.
So I actually did have a call late last week. A property buyer spoke to me late Friday afternoon about a purchaser that he'd arranged his finance and had seemingly fallen over at auction as the rate rises impacted his borrowing capacity. So a variable situation, and that's what we'll be looking at this week to try and help them out to close that sale.
Yeah, same thing. I'll why that happened as well.
That's pretty scary though, because you're still under, once you sign that contract and you've got obligations to meet. Whose fault does that come down to, Zach?
Well, I suppose it's no one's fault. I suppose the product that you opt for through us, if it's a fixed or a variable scenario, we've got the ability to assess any sort of scenario for our clients. But in the situation where you have a variable product, it is subject to rate changes.
So because someone will, always be looking to point the finger. Sure, someone's always looking to point the finger, right?
Always, mate. It's just you've got to pull your socks back up and figure out another way. There is always another way, and I'm sure we will resolve plenty of those scenarios.
Yeah.
I've got a question. Mortgage brokers around you, friends that are brokers, are they fixing or are they variabling?
That is another common question. Should we fix or should we go variable? The first rates to rise were the fixed rates, and the variable rates are slowly following. I mean, from a rates perspective, we're still seeing rates as low as 1.96% for variable. The fixed rate's a little bit larger, but I mean, a lot of people are taking the gamble and going variable. Some people are still considering that things will get further out of control in the next 12 to 24 months and are fixing. It is a mixed bag. However, a lot are going variable at the moment, Mark.
What are the lads doing? What are the ladies and gentlemen that are brokers doing?
As I said, mixed bag, mate. There's a circumstantial essence that we need to assess every time a new client comes with us. So it depends on your service.
You guys with your own money, what are you doing? Like in terms of what's the in the office, what's everyone? Are they going? We're going to be fixed, or we're going to be variable?
Variable, very competitive.
Interesting.
There it is. You're hearing it. I've got to ask Zach, who's going to? Oh, let's ask the question first. Is it getting a formal valuation a good way to negotiate price down? Has that ever been the case, Mark? It's interesting. What do you reckon?
I think it helps. I think you got to negotiate your price, and then if you get chiseled on the valuation, you try to chisel the price a bit more.
Yeah. Okay. But I've got to ask, what type of buyer is going to get hurt the most here? Is it the first home buyer? Is that the obvious choice?
Was that a question for me, Billy?
Yeah, for sure. Zach, who's going to get hurt the most here? Is it the first home buyer out of all of this?
I don't know if it's about getting hurt. There's obviously factors that will change first home buyers' position in the market. Compared to the last decade or two, the rates by comparison are still very low, and the government has increased its positions for first home buyers under the national scheme. And again, look, we're forecasting a more competitive market in the shorter term. Affordability has always been an issue for the first home buyers, but on the 1st of July, the price caps do increase to include up to $950,000 for first home buyers to slot into the market. So with as little as a 5% deposit. Look, there is still plenty of opportunity. There obviously are income thresholds, but it will be an interesting time.
So that's going from 850 to 950.
Yeah. So depending on your suburb, between 900 and 950.
Really?
Okay. So they do it by postcode, do they?
Yeah, there's a tool on the government website that allows you to search a postcode, and it spells out the caps per postcode. I can share that with you guys to pass on to your clients.
Yeah,
that's cool. So anything else we want to talk about before we wrap up with Professor Zach, mortgage broker extraordinaire?
I'm just definitely interested to see how this looks, for the next coming quarters. Do you expect there's going to be, rise on rise on rise because it's, following trends with the states, or what's the forecast looking like for the next couple of quarters ahead?
Well, I think it's evident that the RBA is in a rate tightening cycle. So, we will see more rises in the future. A lot of economists are predicting roughly 2% worth of rises in the next 12 to 24 months. But yeah, look, there's wage growth statistics due out and the economy is still pretty buoyant. So we should be okay.
I got one. Ben's got a great question. Can you answer this one, Zach?
Fire away.
Billy?
Trying to do a substitution of equity, then refinance, or am I better to just get new finance right out of the gates?
Yeah, great question. I think on average, the Sydney properties made gains of around $300,000. So if you do have that equity in your property and your bank does allow you to finance, could be a very easy situation for you to pull cash out. But again, if you're not happy with your current lender and you want to seek a better deal, then we can definitely help and look to get new finance from a new lender.
So Ben's just sold prior to auction, and he's just about to buy something, and he's trying to take that loan across to the new place and just swap out the property. Should he get a fresh bad boy loan, look at the interest rate, redo the term, or should he just swap the equity around?
Tell him to give me a call. We can check out his scenario for sure. If he is waiting for a product to expire, his existing facility to expire, we can arrange bridging finance to, get him into a property if there is one that comes up quickly before he's actually settled. So there are plenty of options for his scenario.
Yeah, cool. I think it's interesting. You were saying when we were in the office the other day that every single person you get on for a refinance, you save money for.
Sorry, Mark, can you please repeat that? It echoed out.
Every single person you refinance, you save money for.
Yeah, absolutely. There's, as I was saying about the rollover rates from people who are coming off fixed periods, their banks aren't generally, offering a deal that might continue to save them money. So there's definitely an opportunity to save by going somewhere else.
Zach, I've got one more question for you. Why are people not talking to brokers more regularly then? Because you guys are not, charging a hefty fee up front for the consumer, even to just have a quick chat. Why do you think that is?
That people aren't talking to brokers?
Yeah.
Well, I guess it could be a sign of the times, Billy, that people are sitting on their savings. They don't want to leverage. They don't want to be in debt, so they don't need our service. But it's a good point. We are a free service, and our job is based on representing the client and making their property journey as smooth as possible. So taking that out and away from the lenders, their priority as banks and lenders is to lend money. So whilst they do have brokers in-house, our job is customer service related, and we're focused on the client.
Sign of the times.
Sign of the times. So I think pull your finger out of your bum, everyone. Talk to a broker. It's free. Zach, where are you from?
DY, Mark, around the corner from you.
DY Shore Financial.
That's it. We're based in North Sydney, so I spend my time between here and the office.
There you go. So thank you for coming on the show.
Thanks for having me, boys.
And we want to have you back.
You let me know. Say when.
All right, guys. Billy, thank you as well.
Thank you. Thanks, Zach. Appreciate it.
Thanks, gentlemen.
Take care. Didn't work.